Hey everybody, macro update from yours truly, the market sniper. Yes, indeed. Boy, we've been listening to some opinions and some of them are losing their way. Some that I thought were sound money advocates. Yes, and there's so much to share with you. We'll delve into that little issue shortly. But it seems that generally it's important for somebody who just comes out every now and then and just goes back to basics and states exactly where we are as a trend, a macro, and debt markets. Of course, we have to talk about debt markets, but we're going to talk about equity markets. We're going to talk about the effects, the reset, what you should be doing, gold, silver, all of these things we're going to talk about in this video, and we're going to entertain you. We're going to entertain you as well. So let's go to this chart right now. Boom, chakalak. There she is. What have we got here? We've got the US 10-year. We've got the US 10-year 40-year bull market, because this is the yields on the 10-year, not the valuation. This is a 40-year log scaled because it went way up top here. You can see the yields 15.7%. Round about the 80s, you can see this. What happened round about then? Gold happened. Silver also happened. Gold happened big. 40-year bull market in the bond markets of generally globally, but we're looking at the 10-year US. Treasuries went up. It was the perfect 40% for the 60-40 portfolio that was 60% equities, 40% bonds. Down, down, down that yield went, meaning ever higher appreciation in the actual capital value. And then, as we have asserted so many times, and so few people, and this is one of two things: I either lack any form of self-awareness, which is quite possible, I'm not watching the right channels, or there's a third reason that I'm not even aware of. But very few, I can't think of one, very few people are hammering home this one key salient point that everybody needs to hear. This one key salient point that everybody needs to hear. Listen up, because here it comes. The debt market trend turned in 2020. The debt market trend of 40 years has turned in 2020. And what you need to understand about markets is, with that capitulation in rates, which was peak bull moment for bonds, when everyone was in fear and bought big old Uncle Sam's debt instrument because they are good for it. They have the biggest military. All this nationalism, this American nationalism that seems to be coming out of a lot of mouths at the moment about being the least dirty shirt in the laundry, and all of these other cliches that absolutely need debunking and burning in a bonfire of vanity, because vanity it is. That was a turning event, my friends, for debt. And if you have any doubts, I'm going to go through the charts that should dispel the doubts, because the charts are the truth, and it's where I refer to for truth, not what they tell you, not what the news media is saying, not what other influencers are talking about, but what they're doing with their money. And that is shown up in the charts in everything that I'll be showing you. So, chart number one. Debt market ended. And can we point out that what takes 40 years to build up in an excessive, exuberant, unbelievably large extension to a credit card that was continually given on being a superpower, the hub of technology, all of these other things, suddenly reached a point where the people aren't so comfortable buying it. And I'm not only American people, I'm talking about international buyers. I'm talking about everything else. Plus you bifurcate the world, plus you steal dollars from Russia, and you make it no longer an agnostic system. You make it a political system in the SWIFT system, plus many other attempts at suicide that have seriously wounded the once strong alpha male. This is not a projection on the beautiful people of America that are my friends that I love meeting when I travel there. This is not a prediction on your values. This is a fact of who captured your system at the very top, has not pursued sound money principles, has gone for the Bolshevik communism results where they prove capitalism has failed by doing everything that is possible to do a totally controlled demolition. Remember, these people, the same people behind that, you know what I'm referring to, are doing the same controlled demolition of the financial structural buildings. The explosives were set, and the buildup of a consumption-only lifestyle, put it on my tab, both at the citizen level and at the government level, has led to an ever-expanding bond market that actually was managed to be orchestrated into a bull market. It was getting a bit iffy, didn't want to make new lows here, but hey, we've got a crisis that can cause all sorts of fear and get us a bid again when everybody else dumps everything else. And the other chart in the bottom half of this is the gold-silver ratio. Gold as money, as the French called for their physical gold and said, have your dollars, before 1971, when America was carpet bombing more than in World War II, more bombs dropped than in World War II, throwing money at the military-industrial complex and the dark state, and of course the space exploration that was actually just a movie that allowed really fat budgets for all that fuel going to the moon. All of that money created dark state expenditure that mainly benefited the military-industrial complex, my friends, mainly benefited the bungs that go with arms dealers, the corruption that you buy politicians with. It is a dirty little marriage and you aren't in it. And they are taking at your expense, and they have been destroying, contaminating your currency and your market with ever greater proliferation. And we spoke to both Prof. Werner on Germany and Japan, and how they still captured vassals almost of the Grand America, how Hiroshima and Nagasaki was not necessary. The Japanese had already prepared to sign unconditional surrender, but Oppenheimer, the genius, make the movie, isn't he cool? Did a burnt offering, known also as a holocaust, of, you guessed it, hundreds of thousands of Japanese people to test this beautiful tool that they'd been developing. Why not? And high-fiving up and down as kids and normal human beings, entirely civilian and citizen, were roasted alive. Of course, Dresden was their own version. So, with all those lovely little political touches on the history of war and who's behind it all, the other financial system, gold divided by silver, the gold-silver ratio, which is a sign of how bullish the market is, only higher being absolutely awful and lower being great for gold and even better for silver. At the same moment that this puked all the way to super strength for bonds and super low on the yield, the one items that were suffering the most was, of course, silver first, then gold, and the gold-silver ratio spiked to its all-time high of around 128. It is absolutely the way in the technical world that blow-offs finish bull and bear markets. Bear markets in the rates, bull markets in the valuation. You know, we've hammered this point home on TLT with shorts before it even was a head and shoulder. We were shorting it on an inverted HVF at the top of its head, said it will probably bounce at our future guest neckline, which exactly what it did. It shouldered and has now made even that head and shoulders target to the downside. It is such an absolute loss in valuation that it transcends the pace of 40 years of bull market in this period of downside. And for this reason, I will take you to that very chart so that we can have a little bit of a look at it. So we will say goodbye to that, and we will go TLT to highlight it. And there it is, friends. There it is. So this short call that we made up top here, This is, again, a big time frame weekly to capture the final moments of an extreme bull in the debt market. It was up top here. We had an inverted. We called for the short break up top there at 164. We expected a bounce at 135. It was where this falling wedge had supported on the way up. There it is. There you go. You can see it right there. Beautiful, beautiful. We said 135. It absolutely ran that 135, gave quite a chunky right shoulder, triggered that shoulder all the way through. At key moments, we heard, buy bonds, wear diamonds, from multiple of sources that I followed in this period. And of course, that head and shoulder triggered, it sold off, nice rising wedge here, which is just continuation, and smashed the target that we gave through 100, when prior up top here it was 180. At its absolute high, our short called in and around the 165s. That is the rate of decline that an ETF of long-term debt, a portfolio of long-term debt, has done. And every rally has been a shorting point, I would like to hand out. Once you under key moment and key point, if you get the macro trends right, trading and investing becomes about 10 times easier. And there's so much disinformation, so many people to lead you astray on what those trends truly are. And I'm trying to set the record straight. If you were bear bias only on this and you shorted every single rally, you are sitting in clover, my friends. You are sitting in clover. The market moved in your favor. And I'm here to tell you, it ain't over. It's going to get more disorderly in due course. Watch me, hear me now, stated to you as I have continued to state on this short that started way back in August when we called top on the bond market for the first time ever that we made such a call. And I will say it's accurate, not out of ego. We get plenty things wrong all the time. It is the most important call because it is the timing for the collapse of your fiat system. Money is borrowed into existence. The failure of debt is currency crisis too. And that plays out by the dollar being a wrecking ball against the other currencies before failing on its own. But we'll be coming back to that. And the nationalism I'm hearing that goes with it. So that is the TLT. That is debt. And I want to highlight to you, if you go to a bigger time frame, how slow actually this climb looks. And this isn't going back to the 80s. It's only starting at 2003. How slow this climb looks. This, my friends, is what they call the escalator in terms of how quick that actually looks. And it ain't done yet. Escalator up, elevator down. And it gets so disorderly that even central banks can't control it anymore. Markets at the extreme set interest rates, not the Fed head and his committee. Markets set rates. Ask the British during the attack of George Soros, when the bonds and the debts were being sold and the pounds were leaving and turning into dollars and other currencies, they did 2 rate hikes on the same day. Did they choose to? Did they change their mind? No, they had to keep up with the collapse of their debt market. Why? Because it's all in pensions and all the elderly won't get paid. Every reason. Everybody who's been stuffed with the most toxic asset in the world, debt. Hear me now, debt. The worst asset in the world. Asset in the world is debt. And if you didn't learn that in subprime and you didn't learn it before, it's now at ever more extreme valuations. So let's talk about debt. Great. Here we go. This is, now there's all kinds of debt, by the mind. This is a world of financialization of everything. There is all kinds of debt. So maybe we can start with that. This particular drawing is showing the government debt. The government, US government, Granny Yehudi Yoda Yellen, she is sitting there and she is presiding over the parabola. This is going to become the joke when the Columbia crashed. Columbia, however high it might have been, whatever it may have been doing. Oh, they handed the steering wheel to the woman. That's going to be the gag that comes. She's been the fall guy. She's set up as the patsy. I don't have that genderist view, by the way. It's probably just some humor that's going to come out. It started long before her, and it was accelerated under Greenspan. He is certainly one of the greatest economic criminals ever to inflict mass poverty and accelerate the billionaire class and the hollowing out of the Gini curve, part of their agenda of stripping you of everything and leaving you with nothing, ergo the World Economic Forum policy. This, my friends, is a parabola. This is called a parabola. It is the beginning of extreme exponentiary. And you are at 1.1 trillion. 1.1, and it is guesstimated at current rates that before the end of the year, that will actually extend to 1.6 trillion at current levels of rates. So you see there, the scale ended there, friends. 1.6, where every one of these is 2, means you're at about 1.5 there. 1.6 is somewhere here. Join that little one up before 2025, and you have a line like that. How does it feel? If you're thinking hockey stick, you probably understand. That is where you are heading. And that is without our reset policy and theory. By the way, reset, the phrase, the reset with the computer power button, we have had for over a decade, long before World Economic Forum started calling reset. And now the reset has come. And the reset theory is interest rate spikes due to the devaluation of debt. No bid. And the Fed, as Bill Holter was quite correct in stating, will become the buyer of last resort. Don't forget, he has his proxies. Belgium, the UK and Japan. Yeah, all part and parcel of the same co-opted, hold it together for as long as we can before it's all plunger down, controlled demolition, all the debt explosions goes, implode, free fall into footprint, financial system, legacy, problem, reaction. Here's our beautiful new shiny solution. CBDCs, UBI, and there's a lot of you around. We could do with a little less. Yep, you guessed it. And that, my friends, in a nice, dark, humorous kind of way, is a possible outcome that people are underpricing continually, and I think it's my primary probability. So let's talk about other categories of debt. In fact, I took some screenshots of these. What is actually happening? Let's clean our face a little bit and make this guy a little bigger. That is Ben Ricketts. Give him a shout out to him. Give him a follow. 200 will do. Thank you. Maybe a tiny bit bigger. Don't freak out. No, you didn't have to go to 1500. 500. Okay. Kind of pixelated a little bit. Let's go 4. It is quite clear that China, by the way, for all these nationalists who are so proud and you know, America's the cleanest shirt in a dirty laundry and etc., all of this. You've got to understand, you might be the last to fall, but fall you will. It's a bit like saying I'm the dirty overall, the shirts and the underpants and the flimsy little G-strings go into the washer first. But in actual fact, unfunded liabilities in America are way beyond anything they could ever meet. And I had Boston professors of economics already put it through 600%, and that was around 2017. Unfunded liabilities, welfare, Medicaid, no money put aside for that at all. You boomers and zoomers and Gen Xers and the future generations of them are going to pay for this inverted pyramid of demographics. Good luck with that. Japan's already finding out. We'll be coming back to Japan and the yen in a minute too. We're going to be talking about a lot of interesting topics. So what basically does this chart say? Well, there's probably some devaluation in this in terms of the treasuries because it's not exactly a performing asset, in case you didn't know, with interest rates climbing higher. But the US Treasury securities, foreign holdings, China, dropped down to 775. How much of that is loss of value and distribution? A little sprinkling of distribution, one might wonder. The US generic government 10-year, they are not holders and buyers. You don't need to be a great chartist to see the juxtaposition of this particular curve on either side, 10 years or general holding of debt. So in short, China ain't buying. Now that's a problem, because as much as America is the most awesome nation in the world and is the cleanest dirty shirt in the laundry, actually everything they buy is made for them by another nation, and they have to pay them. And they hope that that money circles back and supports their US Treasury system, a virtuous little circle, a little infinity loop of a circle jerk, some might say, of Ponzi scheme. Unfortunately now, the Chinese that are providing all these goods lack the appetite for continuing the infinity loop of circle jerk debt support system. They've decided gold is a better idea. In fact, they've even told their citizens to start buying silver, having told them to buy gold before. And they themselves are hoovering it up, dark subsistence mining via Hong Kong, via Dubai on a level and the normal ways, along with the new exchange, where real price discovery is more likely to be occurring. Did you know the Shanghai price of gold is higher than the COMEX? Isn't that convenient? By the way, the three charts of gold, the gold on the London close through to the New York close price, then the actual gold price on all the whole days of trading, and then the Asian price just on the open of the Asian session to the closing of the Asian session. And if I were to draw you these three charts as an overlay draw with a nice, very basic thick Koki, I've seen it a number of times, I wish I had it, it would look something like this. Over decades, by the way, this is not a recent phenomenon. If that's the zero line where this is time, many, many years, much as it shows there, the actual US session is in fact a loss of value in the gold chart. It goes like that and it compounds down. The actual gold price and gold charts for all sessions is looking over the length of the system, something like this. And the other half that captures the Asian session is actually looking something like that. That's right. That's how you get this gold price. It is actually a hybrid of one selling it down and another buying the damn thing up. That is why we've said gold is moving from the west to the east. It is how we see it. And I think it's a discount window being held open for not doing a disorderly dump of those so valuable treasuries that there are millions, billions, and actually trillions of. That is what some people will tell you, that buying treasuries remains potentially a good thing. And I'm going to take those people on that message because debt is over, friends, as an asset class. And doesn't matter if your currency goes up because everybody else borrowed in dollars. Long run, the debt system fails. That means the fiat systems associated with it fails. That doesn't mean the dollar doesn't go up against the other currencies. It means it goes down against gold. Down against gold. And not just gold, by the way. There's other commodities. Let's take a little tangent. But before we take that tangent, we should probably have a look at this other chart that I had prepared for you. This chart is highlighting mortgages. Mortgages. Yes, the housing market. Let's have a look at the mortgage market, should we? This is the mortgage market. This is mortgages in America. That's right. The home of the world currency, mortgages in America, right here, right now, and mortgage applications. So as you started heading into the ultimate highs of the subprime crisis, which, by the way, was stoked by Greenspan in reflating. Remember the 96 irrational exuberance that led to the dot-com melt-up that saw a slight pullback in wealth factor over there. Dot-com crash. Hey, we'll lower the rates and keep the property market pumping. And that Greenspan was responsible for. He stood down and left many of the others to enjoy the bubble, the rinse of his great bubble. Applications hitting 500, God knows, 500, 498. Is that millions per week, month? Whatever the matrix is, this is relative. You could understand that at subprime, this was already very, very low, post the subprime 2009. However, more interesting, it's a leading indicator. Now, if you talk to me about one thing I love, it's a leading indicator. People like me's sole job is to look into the future and see where things are going. And for that, we use leading indicators, things that can tell you what's likely coming down the chute before it actually pops out the chute. Is it a raccoon or is it a bear? Choose your weapons accordingly. Yeah, so when this is happening, you can see that this peaked out up top there, which was prior to the big crisis. They started to turn down. The mortgage application started to turn down. Even in 2006, 2007, you were still high, but you were trending down. Before 8 and the great Lehman's event, you were actually seeing a thinning of volume. As you get to the top of markets, a lot of bag holders decide they might not want to be bag holders. They might want to lock in profits instead. And they start getting out. And there's that thin distribution, and the strength going up is hitting stall speed. The prices at this level are getting less validity with less votes in the system. That's a buyer meeting a seller. That is a vote that this is a fair price. I'm okay with doing it at that price. And when you get less votes in the system, you start to have a lot more people looking down. The thinning of the volume is a leading indicator. And here's where you are right now on US house pricing. You are getting lower mortgage applications, the lowest level since 95. That's very helpful over there. And by the way, that was pre the property being so weaponized. There was the savings and loans crisis. Everybody chilled on property for a bit, and it wasn't such a financially engineered. There was always mortgages, there was always everything, and people still made money on their properties in back day, but it didn't become a national obsession where your neighbors were strippers who had 5 homes and crypto traders. No, sir, it weren't quite like that. Flipping 6 condos. And you can see where the volume is now. And what do you think it's telling you? At the same time, I have seen stats, and I have too many charts to show you in this one clip. It will be 3 hours long. Highest available number of properties to sell right here, right now in Florida. Record highs. Further anecdotes tell me that certain veterans are buying for $600,000 properties zero down. Now, zero down is something close to my heart. I participated and ran a property company in the United Kingdom during the buy-to-let era, and we organized zero down deals with gifted deposits and all sorts of legal but certainly leveraged takes in the property market. And I remember losing my appetite for the business as 06 and 07 came, and ever higher valuations were pushed through. Simple constables were given £2 million line of credit to accumulate 4 or 5 apartments at that time for around $250,000, 300,000, etc. That was a precursor of unsustainability. Zero down, no skin in the game, actually all the skin in the game. You're moving into a bank's apartment. And what? You're on fixed income in an inflation environment like that? Inflation. Francis just mentioned inflation. Let's talk about inflation. And that brings me to the likes of shadow stats. shadow stats. What is the true inflation rate? You're going to hear some clips where people are almost making the case for the dollar and the dollar debt system, that it's actually a place that makes sense to even buy into. And I do not agree. So let's be clear. Real inflation is not what they tell you. In fact, shadow stats is still utilizing a government-based tool, the one that existed in 1980. That's right, Reagan's era, 1980. It isn't some concocted formula of some conspiracy theorist that just hates government and is trying to show them up. No, no, no. It is, let's keep using the measure they originally used. What number would we get today? In short, it was good enough for them in 1980. Surely it should be good enough today. Well, this is the rates you get. These are the rates you get, and I'm here to show you the difference. And you're sitting here at near CPI. That's a bit of a fat cookie. Let's go a couple of levels down, shall we? We're sitting here at just a tick below 8%. Call it 7.5, 7.75. I'm not going to argue one way or another. This is the just guide level of where inflation may well be. By the way, consumer inflation, official stats, 1980 based. This was 1990 based, by the way. So we gave you 1990 is 7.5, 7.75. 1980 based, the land of Ronald Reagan. Don't forget, gold all-time highs, Richard Nixon. Yes, yes, yes. Temporary removal of gold convertibility. Only temporary. Only temporary, and temporary is whatever a politician wants it to be, and it seems it's lasted 54 years. Pretty temporary to me. Oh, well, anyway, let's not enjoy the tricky dicky lies that much. 12%. On 1980 Ronald Reagan stats, 12%. That's right. That's an indicator of the general consumers, 12%. And by the way, if you're watching this channel, because you're smart, alert, and generally an achiever of note, you're likely higher. As a high-performing, smart individual who understands that reset is coming and has hit the like button and subscribed, you're probably aware that you're just a little smarter than all these other guys. And you're paying a lot more because you're using better quality items to eat, feed yourself, look after yourself, and as a result, the costs go up even more. It goes up the higher the income scale you go, although it's more damaging to the poor, because low inflation, if all you do is eat and heat, and that goes up and you have very little disposable, 5% can kill you. 5% can kill you because it's the difference between having a few dollars left at the end of the month and going into debt every month. And many are going into debt. What do we use? Credit cards, well through 1 trillion now. And the average interest rate has now hit a record high on credit cards. That's right. You think this isn't debt? I'm here to tell you, this is debt instruments. Who do you think's keeping that debt? All the banks? It gets repackaged and securitized and sold into the market. An investment. Buy this investment yielding 21 point whatever it was percent. You don't need to know the decimals. 21% is a new high average payment rate on credit cards at a time when the credit card debt is through a trillion. A trillion, oh, trillions, billions, these sound out. Okay, 1 second, keep counting, no sleep, no rest, don't stop. Count to 1 million, 12.5 days. Count to 1 billion, 32 years non-stop. Every number, every second. Count to 1 trillion, 32,000 years you are revisiting all your lineage of ancestors back to being a newt in a flipping pond. Pre-dinosaur. That's right, my friends. That's 1 trillion. And it's through 1 trillion in credit card debt with an interest rate yielding for those investors 21% until the consumer can't pay anymore. Until that consumer can't pay anymore. How are you doing? Does that 12% plus feel like a closer representation of the inflation you get? Maybe you're still unsure. Let's take in some charts, shall we? Let's take in some charts. Right. Not the typical things, gold and silver. Let's take a look at your coffee beans. Your coffee beans, you know this one. We told you this one. We gave you this trade. We gave you this trade down here. This is the most expensive coffee bean. There are substitutes such as Robusta. I'll be showing you that next. Up, up, up she goes. Massive profits made. Thank you. Delighted to have it. But is it good for us? Is it good for you? Hey, I don't drink coffee. I've got more energy than I need anyway. I don't do stimulants. I don't drink alcohol. Yep, you don't believe that, but it's true. But you do, and all your friends do, and your wife doesn't go to the toilet for a weight management routine if she doesn't have a coffee. So guess what? Lots of people are drinking coffee. And the price go up. Price go up. But maybe it's a flood. It's a flood in Brazil, or Ghana had some labor strikes, or Indonesia, Malaysia, the Jamaica, the beans, there was climate change. Climate change, man. Don't you know? Everything comes back down to climate change. That's why the coffee price went up. Okay, well, they grow different beans in different places. What about the Robusta chart, you say? Well, let's take you to it. Let's take you to it. The Robusta bean chart. RC1 dot there. Take me to the futures. Let's see. A different bean, a more robust bean. Let's have a look at it. How's it been doing? Ooh, dearie me. That seems rather uppity. Let's have a look on a bigger time frame. Maybe it's just having a good day. Well, it seems to be having a good week, a good month, and a good year. Well, it's just going to start hitting. By the way, this is the stronger tree. It doesn't need to be at a certain elevation, not too high, not too close to sea level. This one can hang out at the tough areas. More bitter bean, much more caffeine kick. You know, a nice mule spike for you that don't get started in the morning. Try a cold plunge pool, by the way. Anyway, uppity go. 1770 coffee beans. Many of these things grown in Africa, where labor is cheap and you can persecute people and do subsistence, labor exploitation practices, like the cobalt mining that's driving the Tesla car. We're going to be coming back to that one. I think you're going to like that one in a minute. Hit the like button. That's gone from 1770 to starting with a 4. Starting with a 4. That's right. That's huge. It's a massive move. Okay, well, what about the substitutes? I'll just quit coffee and drink cocoa. Let's have a look. Cocoa. Here she comes, here she comes. Wow. I mean, wow. Let's just take that to the weekly. It must be something. Maybe all agriculture is affected by climate change. How about that? All yields and all crops are down. No. Crops are roughly the same. Crops are roughly the same. But you're having to pay more beans for the beans. That's what's happening. You want the beans? Stump up the beans for the beans. And that's what's happening. Cocoa is higher. That, by the way, was as low as 2,186. 10,000. Recently traded 11,700. So let's just summarize. 2,000 to 11,700. But was that long ago? I mean, we are on a weekly chart now. 2022. I mean, I'm talking 2 years post the big event that I highlighted on the gold and silver ratio, that I highlighted on the debt yields. Isn't it funny how the inflation started to take off in all of these things? Inflation is central bank policy. Hear me now. I'll say it again. The central bank's policy is to inflate and diminish the money that they issue to make you poorer. Third time, they own you and control you by keeping you on a treadmill, a monkey on a greased pole, by inflating and devaluing the currency. It is their policy to do exactly that, as part and parcel of controlling you in their monetary system. You hear that? I hope you got it. It is absolutely policy, and this is more decline of currency, priced in dollars, by the way, than it is anything else. Broad, general inflation across the board, moving softs. We've also got the metals. We know we're at, the mid-80s to the 90s oil. Whatever happened to $30 oil? What happened to $10 oil? Well, that dollar buying power just went down and down and down. But hark, people will tell you some interesting stories. Yes, they will tell you interesting stories. Let's get to some of the interesting stories. Here is George. We know George. We like George. We speak to him. We've spoken to him on his channel. But the messages are starting to concern me a little bit. Some of the messages are concerned. It's confusing the audience. Let's listen to this, and I'll put it nice and loud so that you can hear clearly some of the research that George has put us through.
Right. But let's just say that it's, I don't know, 2%, something like that. So in the last 12 years, you've seen maybe...
He's talking about Japanese inflation. Let's make it a bit larger so you can see it. Japanese inflation. There you go. That was smarter. Increase the size. Let's go back a tiny bit. And he's talking, it's so low in Japan, he says, that over the last number of years, it's not particularly meaningful, but let's say 25%. Let's listen again.
Years of deflation. Prices and yen are actually going down, for heaven's sakes. So what's an average here? I don't know, 1.5, something like that. So let's just assume it's 1.5. We don't need to go to the compound interest calculator because it's all about the concept here. So it's not about the precise numbers, right? But let's just say that it's, I don't know, 2%, something like that. So in the last 12 years, you've seen maybe compounded prices going up by, call it 20, 25%, something like that. And that's being conservative, right? It probably didn't go up that much.
2% over that time of years will compound beyond 25%, by the way. It's not the multiple of the two. But anyway, let's just leave that minor mathematical.
But now let's go over to the yen versus the dollar. And if we go to 2012, we can see it was right around, call it 78, 79, something like that, call it 80. Now where are we? 154. So the dollar has...
So that is an all-time secular low moment that has been selected against the yen. And in fact, everything to the left of that chart prior was higher. So we've had a turning in the yen because of their debt situation. So using Japan is a very special case, I will highlight. But let's leave it there for the bit. The bottom and the subsequent destruction of the yen is videos that we have covered with Professor Werner and how they were made to do quantitative easing, how an entire bubble was created, and they are further ahead in their collapsing fiat currency and debt environment than any other advanced nation. So it is quite a useful benchmark if you want to be a little bit making your case look sweeter than it is. But anyway, let's let George carry on.
It's almost gone up by 100%. Yet the price of the stuff you buy has only gone up, if you're in Japan, has only gone up by, call it 20%. So think about that for a moment. If you are holding dollars and you lived in Brazil or Japan since 2012, your dollars haven't just been a store of value. Your dollars have appreciated massively in value, massively in terms of local purchasing power, which is all you care about. So the next time you think about buying government debt, are you going to hesitate to buy government debt denominated in US dollars? Are you going to hesitate to buy treasuries? Absolutely not.
No! No, George, no! So, what have you proven? You've proven that if you live on a dollar-based income but happen to live in Japan or Brazil, and I can add South Africa and a whole host of nations, in actual fact, even if you're on fixed income, where you say retired and receiving a certain amount of pension, that in actual fact, the domestic inflation of that country has not matched its rate of decline in its local currency to the dollar, meaning you have had additional buying power and a better standard of living. That's all it means. That's all it means, George. It doesn't mean you buy T-bills at the end of a reset crisis. I am so sorry, but I have to greatly disagree from the jump from one currency currently superior and outperforming many others, which we have agreed with, and we say the dollar will be the wrecking ball by going up. And what will be driving that dollar go up? We need to listen to this again because I want everyone to hear it. I haven't misconstrued a very nice, good guy who's doing his damnedest, but I think is taking a few steps to the wrong side. And I see this with Brent Johnson as well. And they are kind of a group together. So let's see and listen to that one more time. And I'm going to slow it down a little because I kind of like things to come at me fast. I got energy, get to the point. I'm coping. My brain's moving. But let's slow it down for the slower amongst us. And we're going to go back down and just make sure we heard this all right before we cast aspersions over a great gentleman.
And when you went there, you just had $100,000 in savings and you just kept it in the bank. And you got 0% if you live in any, because it doesn't pertain to you in any way, shape, or form. And was positive numbers. You've still got 1, 2, 3, 4 years of deflation and prices in yen are actually going down for him.
So he's not just comparing Japan, he's showing you other European nations, but then he's also compared Brazil, and let's go on. And by the way, it's quite important to remember that inflation does go up in these lesser nations to the dollar currency. And you will have benefited by being on a dollar income living elsewhere. And I say to everyone in America, leave America, take your American income, it's the only thing you have. Of course, convert as much of it as possible to gold, actually, but use for your daily living costs dollars wherever you're living in, South Africa, Brazil, wherever you're living, and you will get a benefit. That's what George has actually proven. The fact that inflation will not match the devaluation is part and parcel of margin compression locally and certain nations being bought in cheaper and having cheaper pricing. So let me tell you, in certain countries, you can buy and live for a lot cheaper on a lot less. Why? Because there's more poverty, there's more excess of labor, and prices for creating things. We have this in South Africa, you'll have it in Brazil, you'll have it in probably Indonesia. People live on less and things are cheaper. So you can have that, things cost a whole bunch more in advanced countries, even the identical items. Even Amazon and various things have pricing policies. Apple and various companies have pricing policies for different countries. So you can have inflation that is 25% since 2012, over 12 years, and still be in a better standard of living than if you'd lived in America. Let's listen to this statement again.
For heaven's sakes. So what's an average here? I don't know, 1, 1.5, something like that. So let's just assume it's 1.5. We don't need to go over the compound interest calculator because it's all about the concept here. It's not about the precise numbers, right? But let's just say that it's, I don't know, 2%, something like that. So in the last 12 years, you've seen maybe compounded prices going up by, call it 20, 25%, something like that. And that's being conservative, right? It probably didn't go up that much. But now let's go over to the yen versus the dollar. And if we go to 2012, we can see it was right around, call it 78, 79, something like that, call it 80. Now where are we? 154. So the dollar has almost gone up by 100%. Yet the price of the stuff you buy has only gone up, if you're in Japan, has only gone up by, call it 20%. So think about that for a moment. If you are holding dollars and you lived in Brazil or Japan since 2012, your dollars haven't just been a store of value. Your dollars have appreciated massively in value, massively, in terms of local purchasing power, which is all you care about. So the next time you think about buying government debt,
whoa, we went to government debt from holding dollars. Well, you see, that's dangerous, George, because part and parcel of the interest rate theory that is part of our reset theory that's been in our brand for 10, 15 years before I started hearing about the dollar milkshake is that indeed interest rates will climb and they will spike. And what happens when interest rates spikes? The nation that will be at the front of that curve will be America. That's how it gets to be the wrecking ball, because it puts a slower moving Europe in trouble. They have to up rates and kill their economy, or they don't do enough, or they don't do by as much, and you end up with a British pension crisis, which suddenly sees no one wants to buy the debt. They've all sold pounds and put it with Treasuries instead of holding British debt. That's what happens. So what happens is America is the last to fall, but fall it will, and all will have interest rate increases. What happens to the value of your debt, George, when interest rates go up? What happened to that 100-year at virtually 1% Austrian bond. Well, it's lost, I think, 60% of its value since I got away with NERP and ZERP talk and that this is actually a good deal. So that's what happens. Values go down on T-bills. You don't jump from holding dollars if you're living and you need transaction money. I've got zero issue with holding dollars. So gold can't transact. I can't go buy a loaf of bread with a silver coin or a gold coin. So you need cash. Sure, make it dollars. It's going to be an absolute ball. You could have used Swiss francs as well as an example. Swiss francs also gone up next to the Japanese yen. Even the euro's gone up against the Japanese yen. There's been moments while the South African rand has been beating up the yen, quite extensive ones, in fact. So against the Brazilian real and against the Japanese yen, there's actually a couple of currencies that will have done, and in some instances even better than the dollar, depending on the time period you choose. If you want to choose the absolute low of the Japanese yen trade when the yen was at its super strongest point before Fukushima, before the change in prime minister that came after Fukushima, before the proliferation of quantitative easing and the buying of everything and debt destroying policies. But is Japan the only one doing debt destroying policies? No, America just gave $100 billion to Israel and Ukraine and Taiwan. That's right. Where did that money come from? Not from tax receipts. They don't get enough in. They spend twice as much as they get in. So where's it all coming from? Yellen is making new money, writing up that debt. And we issue this here bond. George, are you saying buy American debt?
Are you going to hesitate?
Yes!
Government debt denominated in US dollars? Are you going to hesitate to buy treasuries? Absolutely.
I'm never buying treasuries, George. I'm buying gold. Let's have a look at something else. Well, let him finish.
Absolutely not. When you've made out like a bandit by holding dollars, you've had a windfall.
And Swiss francs. And even euros for long parts. I'll show you a chart of the euro JPY if it needs to be seen. I'll show you a chart of the Swiss franc. That is not a case for fiat currency in debt destruction times where an interest rate spike is likely to see the disorderly decline in values of a super proliferated debt market, which is why I started with the very first chart and said, do you conceptually understand the bull market for debt ended in 2020 after 40 years, and that the rate of decline, remember the TLT chart, is disorderly fast in comparison to the 40 years it took to get there. Inside the 4 years, you've already chucked away 2 decades worth of accumulation in value. That's why I mentioned the Austrian bond. That's why I mentioned the most extreme versions of this. And that is why you don't buy debt instruments just because it's based in a dollar. If you want dollars, hold dollars, have some cash. Hey, I say you need cash. Everybody's got to live day to day. And as I've already said, gold and silver don't buy. Sure, transact in dollars. It's probably one of the best. And in this spike, it may actually be the number one, and it will surpass the Swiss franc for a period of. But the end game is collapse of debt. And money is borrowed into existence. The collapse of the liability, which was somebody else's asset, is the death of the money. It's very, very, very not good for assets custodianship. US T-bills are not good for custodianship. And I will put another chart in front of you to make this point again. It is not good. Let's say goodbye to this fellow. In fact, we'll say goodbye to the cacao. What a beautiful, talk about hockey stick. That looks like the mortgage applications chart. Who's buying all that debt, George? You think all those people are paying back? You think you haven't got your next Detroit's incoming? Only on a far wider scale, with BlackRock and Vanguard and State Street waiting in the wings to buy for a bitter, bitter tight blood in the streets price. You can rest assured the owners ain't getting out good. They're getting out with negative equity and a chain round their neck. That's what, and all of the financial system carried over into the new world coming down on them. So let's have it something that's going on in the rest of the markets that Brent, who's been big on the airwaves about the dollar. RBA has a big problem. That's the Royal Bank of Australia. He's retweeted this. It's not his tweet. Bond erosion is accelerating. Funding costs exploding. Producer price index resurgent. All those things apply to all the leper colony rent and everybody else watching. It's not just Australia. Bond erosion. Why can't he say bond erosion on American T-bills? Why can't he say funding cost exploding? Isn't that the interest rate? What's your mortgage fixed rate now in America if you have to borrow? Boy, oh boy, what is it? And is the PPI not resurgent? Is the CPI not being battled on people talking about them even upping the rate of inflation? They're never going to get to the 2%. And this is strangling the retail man in the halves part of the economy and flushing billions into the military industrial complex half, as all that money that's being sent over, apart from the bungs, the slushers to the Biden family, the Zelensky cocaine family, and everything else, the trafficking, the organ trafficking, the child trafficking, and everything else that goes on that was going from FTX's failure and beyond. Apart from that, the final proceeds actually end up in all the statist companies. They come with contracts to be signed to buy missiles from that will be delivered for you to go kill some goyim, Russian goyim, and ensure that they come back to kill your local Ukrainian variety. That is where we're at. Bond erosion, bond collapse. It applies everywhere. That's why interest rates are up. If you can see it in Australia, how can you not see it in the United States of America? Is your inflation not up? Did things not get more expensive? Is there a big bid? The recent bond issuance was terribly covered. Normally they have multiple times over covered. It was terribly covered. There was 62% foreign, and it was all the usual suspects. Don't forget Belgium, and don't forget the UK and Japan. That's right. It was terribly covered and very damp enthusiasm. Anyone want to buy some garbage that's dropping really fast in value? Do you want to buy? I've got some for you. Do you want to buy? No, you do not, sir. No, you do not. And as in Australia, so it is everywhere. You all kiss the same leper. We are in the globe. We have to come back to basics so many times with these people baffling you with new narratives. This is a debt-based crisis. Look into these eyes. I am telling you exactly how it is, and I'm going to make it simple for you. This is a debt-based crisis. Too much debt, too much fiat borrowed into existence. The Fed itself lost over 100 billion. That must mean it has a pinprick of capital, if still positive, and a mega inverted pyramid exposure. This is the toxic bank who will be buying bonds when all the others don't. Although the idiots, controlled idiots, Japan, Belgium, Britain, sure as hell will just continue to gobble them up until they all collapse together. It's ring a rosies. We're putting our arms around together, a tissue. We all fall down. That is the nature of the game. So the firing order, you can know you have a V12. You don't have to know the cylinder order of firing of that V12. Because at the end of the day, it's a V12. This is a collapse. Debt is the reason. Do not own debt. How about that simplicity? How about that? Is that at a YouTube level that you can understand? Don't own debt. There is no reason to own it, and don't have it in as be a liability either, because the interest rates will spike, and unless you have very strong fixed deals, you will find yourself having escalating payments when you least need it to happen. An event similar to lockdown, an event similar to world wars, pandemics, and everything else will take place at the exact same time, geopolitically and socially, that interest rate is going up. That is why I have concerns about Bitcoin, because it fell to 4K. From the better part of 14. You don't need the highest volatility assets because the most you're going to need them is at the worst possible time. It's kind of like the banks. They'll always give you a brolly in the good times and take it back when it rains. That's credit for you. Right there, explained. And I get bewildered sometimes by warbled messages. Let's have a look at a couple of other things, because we are impassioned. We are trying to set the world straight. Follow that hockey stick. She don't lie. By the way, the controlled demolition. I'm loving how this phrase is catching on. Check out good old Jeff, who's with a new puppy. Bless him. He lost his dog. It's a bigger deal than you think. If you love him, Clovered Pivot Strategy, some great updates. Go and check him out. But the controlled demolition phrase is catching on. That little tie-in with the you-know-what incident of just barely into the new millennium. I put it in there as intent, and it's being proliferated. Thank you, thank you, thank you, thank you. What else were we coming here to? We were talking about this. So, protests break out against Argentina, President Milei. They're talking about this. Now they feeling inflation. I can see the inflation. More than a handful, I tell you. But that is nations like Argentina. Just imagine the experience going on there. We've checked into that. This I'll come back to in a moment. So let's go here. Let's have a comedic relief moment. I said I'd refer back to our friend Elongated Maschinas. Elongated is a packaging genius. I tell you, I saw this thing. I saw this right here, and here's the story. The electric car shuts down. It traps the driver inside, then catches on fire. I mean, this is pure packaging genius. Here's why. First of all, the very first thing is you get yourself, with all those cameras, don't forget, there's cameras inside to watch that you're not falling asleep in the wheel. It's got nothing to do with surveillance, this battery car like a big iPhone that you're driving around, tracking you everywhere. That can be intervened with remotely and deliver you to the police station for a hate crime. No, it's got nothing to do with that. It's got cameras looking forward, looking back, because self-driving and all of this stuff. So it's watching you. So actually what you're getting here is you're getting a built-in snuff movie. I thought that was illegal, but anyway, you're getting a built-in snuff movie. And then at the same time, you're getting a coffin service. Yeah, you're getting a coffin service. And then on top of that, you find yourself, you're even going to get a neighborhood barbecue. So you get snuff movie, cremation, full done, on the board cremation, and then on top of that, you're coffined up and good to go. And then the whole neighborhood can come and celebrate your wake. Bring the marshmallows and some boerewors. There you go, slap it on the bonnet, have a barbie. He was a nice guy, wasn't he? Yeah, he's a nice guy. Look at that skeleton crumbling there, still clinging onto the wheels and steering wheel and scratching at the window. It's like, can't wait for the DVD to come out, mate. Yeah, what do you say? I bet he was screaming for his mama. Yeah, oh bloody hell. Makes a nice little fire, this one, don't it? Oh, I think we already, you're through medium rare there. Flip the burger patties. Gom bom bom. Elongated Maschinas. That is him, my friend. You actually managed to create so many products in one that you actually deserve a medal, and that will solve the overpopulation crisis, and it will get rid of all those pesky superior greens that think they're saving the planet by driving this vehicle and haven't done the deep dive research into the subsistence mining that is cobalt and everything else that goes along with these long queues that you will wait for plugging in. Good old dirty Francis. I'm going to plug into that 4x4 and turn that key the good old-fashioned way with that turbo diesel engine, and I'm going to be independent and free. Oh, dear me. That's Elon. Anyway, back to our economic. So, anyone who thinks higher UST yields means US will not be able to place its bonds does not understand the design system. Well, the placements aren't going so well anymore. China ain't buying. Russia sure ain't buying. A lot of nations aren't buying. That means new buyers are having to be found. What's happening? Let's go back to that hockey stick again. Do you remember that? Someone's going to be buying because they got to be placed to be made. They got to be placed to be made. So the bankers, the primary dealers, they sit with them. The Fed buys them back, or proxies for the Fed buy them. But people don't want to buy them. What's your true inflation rate? What are you getting paid on that bond? You're getting, if you're lucky, 5% on the bond. And the true inflation rate, by anybody who understands that the states are fact, is you're locking in a net 7% negative, a 7% negative collapse in that market. You are locking in a 7% while it's not in a disorderly collapse. You are locking in at the yield level, minus 7% in real terms, according to the 1980 government stats calculations themselves. Not Francis's fake number. He's just guessing how much his Rolex went up. No. Fake number made by the government back in 1980 that was already serving them. That's the baseline. We're using their number, their formula today. What did you get? 12.5%. So is buying treasuries a good idea, even if the capital value stays perfectly good? No, sirree. In an interest rate spike environment, they will collapse. This notion of dollar hegemony, because if you're living in a country that is currently in a weakening currency crisis, that means it's further down in its debt collapse and doesn't have reserve currency status, such as Japan, that actually appreciated non-stop against the dollar throughout this post-war era, 50s, 60s, 70s, right the way into the 80s, which for a Japanese person would have been awesome to live in America with their ever-appreciating yen while working for a Japanese currency. Yes, that was the same, and it still doesn't change that they are now where they are with their quantitative easing policy, and they are a forerunner for the America, the dollar, and many others. So there you have it, guys. I think there will be a problem facing treasuries. I disagree with Brent. And anyone who thinks the rest of the world is going to get USD funding that they desperately need, well, that's true. There will be a shortage externally because the interest rate keeps going up. And if the interest rate keeps going up, Turkey, South Africa, anyone else, economic hitman forced to borrow in dollars, will have to get more of them. That means they'll proliferate their own currency and try buy up dollars in the open market, which will see their currency devalue and the dollar get a bid. And the dollar will be strong. It is a part of the process of destroying all the emerging markets that have borrowed in debt, forcing them to the table, IMF type solutions, and it will contagion across all the bigger first tier. But in the end, the debt dies, and the debt is the shadow to the fiat. And the real goal was gold. And the chart that wasn't shown on the Japanese yen, and we are callers of the yen long. We're seeing 1 against the dollar. You know, our next target's at 177. We've been long before these characters are talking about Japan, the Japan guy. No one understood Japan. We've told you to buy the Nikkei, that the multinationals, which have a currency hedge advantage now, they are selling products offshore. We've told you the yen is going down. We told you the original HVF way back here in 2021. That's the dollar, the yen was going to go into a state of collapse right here. So in some senses, this is very much our space. This is the big original breakup HVF in the end. But you have to also remember that in the big scale of things, that applied while it applied. That was what the yen did to the dollar with their unbelievable economic miracle before the debt that was brought to them by special chosen ones to ensure that they stopped saving so much and stopped selling so well and weren't buying enough US products such as treasury bills. That all changed after the World War II, and then quantitative easing created the bubble in the 80s. First ridiculous lending and subsequent solution of quantitative easing put them in the position they are today. In actual fact, they run better corporations, they're a tighter ship, but they've bought into the whole lending, and now the government owns everything at a financial level in terms of banking and everything. They let the Trojans in, and they are a wreck, don't get me wrong. And that yen is going higher. But you could have compared the yen to gold. And guess what? It's an even better chart in the same way that gold is beating the dollar as well. There you have it. So that is the yen, USD JPY. This is the gold against JPY. Let's have a look on the exact same time frame how that chart looks. Ooh! Well, fan me brow with a kipper. If you want to save value, you want to retain balance sheet, you don't trust debt, and you understand what I'm saying, you hold gold. If you want to transact in a foreign currency, and you need an easy transaction mechanism, sure, hold cash dollars, have a small balance of cash in a number of accounts wherever you go. You could even choose the Swiss franc as well. It's not the only currency that goes up, but the dollar's more proliferated. It's more known in Africa. It's more everything. It's the industry standard. I get it. But it's a different story if you're talking about balance sheet retention. That is what the yen has done, and has done it since 2006. Look at that chart. Do you want that chart, or do you want the USD JPY chart? Let's have a look at this on a lower time frame. That's the monthly chart. There was the original HVF. At the same time, we were saying that you want to go long USD JPY. We actually said the greatest trade of them all is the gold trade. The gold trade at 2019 going 2020, you could have got in on that at around 140,000 yen. Now today, 370,000. 140 to 370. That's 280 and plus a half again. Now that has beat the dollar. It's beat the dollar because gold has beaten the dollar. And you can have a look at it right here. There she blows. That was gold at the bottom of March 2020, 683, 2009. This was at $200 at the year 2000. $250 today, going and not far off 2,500. That's a 10x on the dollar. And that's why you don't have all your assets in the dollar. You keep transactional cash in the dollar while you live offshore in a country with a devaluating currency. Because yes, they'll have inflation, but it'll actually be less because the people have to be kept a food line. Otherwise they riot. And that's why the food still has to be relatively affordable, but the luxuries don't. That is the facts, guys. That is the facts. It's a debt-based crisis. The solution is precious metals. Treasuries are not part of any form of the solution. Interest rate spikes will destroy all debt, and every currency that thinks it's done well against the dollar has actually, every currency that thinks it's done well against other currencies has actually been collapsing against gold, of which the American dollar is a perfect example and has in fact lost 97 to 99% of all its buying power against gold. That is the hard facts. You want to preserve your wealth, you're in gold. You want to transact in a foreign currency, you have some dollars. That is the fact. You never buy treasuries. Thanks for watching. We appreciate it. For real, no BS, simple facts and truth. You can subscribe. You can book a call. By the way, you can buy gold on our link below. You can book to chat to us to keep realigning where you're going and understanding clear messages, simple, clear messages of what to do to negotiate resets in these times. And it has absolutely nothing to do with investing in debt instruments in a debt-based crisis that is very well on its way. Till next time, I salute you and say goodbye.